Joining us now, Ruchir Sharma, chairman of Rockefeller International. Ruchir, welcome. You say you still have to invest in China, though. It's just too big a deal?
Yeah, as you know, I've been a long-term bear on China. And so I think that what we need to get correct in China is the growth expectation. And I think that's what the market is doing finally, which is that when you have a country where the population is actually declining and you have such a large debt burden, there's no country in history that's been able to grow at a rate of more than 2 or 3% under that scenario. Once we acknowledge that, yes, that's what China's underlying growth rate is going to be, then you got to still invest there just because the size is so big. It's still an $18 trillion economy. It's still the second largest stock market in the world when you combine China and Hong Kong together. And surely we can find some good franchise names to own in China, given the size of that economy. So I don't think China, yeah.
What does a franchise name in China look like, though, given the issues in the real estate sector, the debt overall? Should you just go with an Asia fund? Do you want just sort of large cap, boring stocks in China? What's too big to fail over there?
Yeah, so let's just take a couple of examples out there. One is BYD. I think that it's we know about BYD and its success on the EV platform and how it's going much more global now after having had a lot of success in China. So that's the kind of franchise name. Then you also have some insurance companies like AIA, or even some of the local consumer companies which are there. So I think that it's not the boring names like those would be the banks and stuff. I think those are challenged. I think it's still in the private sector. It's still these companies which have some franchise value and companies that will benefit from the fact that you have an $18 trillion economy growing at even 2 or 3%. That's about the same growth rate as the US or so. So I think that China for me is that, which is that I've been a long-term bear on its growth rate, thinking there's no way these growth expectations are going to materialize. But I don't take the other side of the trade, which is that, it's become uninvestable now, and so we shouldn't touch China. I think it's just too big and too large an economy to ignore.
Well, interesting signal now that everybody's accepted that the growth isn't what was hoped for. You're saying, but don't throw it all out. But okay, let's talk about the U.S. because you're very critical of the impact of Bidenomics and all of the deficit spending that's been going on. Why should investors fear Bidenomics, and how do you position yourself to protect yourself from it?
Well, on the other side of the spectrum, just like I've been bearish on China, I've been very bullish on the U.S. All of last decade, I kept saying that this is the comeback nation, this is the breakout nation. But the last 2 or 3 years, some of the fault lines which are appearing in the U.S. had me worried, particularly the latest op-ed that you referred to in the Financial Times that I wrote today. What did I point out there? As I was doing the research, what I unearthed there is just how badly the U.S. fiscal situation has deteriorated over the last 2 or 3 years. To put this in perspective now, the U.S. is running a budget deficit every year of close to 6% of GDP, and expected to do so for the rest of the decade.
Yeah, you say within 10 years, government interest payments will exceed spending on defense and on social programs like Medicaid. So what's going to be the impact on equities?
Well, I think that the issue here is going to be that this is negative because I think that for now, all the spending that the U.S. is doing on the government side is keeping growth up. But when you're doing it with so much debt finance growth, it's got to be temporary, and then in the end, that effect wears off. So in the good case, it's just a growth slowdown as the spending is unsustainable and it comes to an end. The worst case is that you get something much more sinister, like a funding crisis for the dollar. So I think having a bearish bet on the dollar to me is something which just seems like an obvious trade at this point in time. If there was one out there, yes, the U.S. has endless capacity to finance itself. So I don't see any imminent crisis, and neither does anybody else. But we just need to put in perspective that there is no other developed country in the world today that is running a budget deficit of the size that the U.S. is running or projected to run. And this was not the case a few years ago. The U.S. budget deficit was in line with the other countries. So this is a significant deterioration that's taken place over the last couple of years.